The opinions expressed on this program are those of the program hosts and guests and not necessarily those of this station, management, staff, or sponsors. WPSL does not endorse products that may be mentioned. Any reproduction or retransmission of this broadcast is strictly prohibited without written consent of WPSL.
Very pleasant good morning. It's 11:08 at WPSL 1590, the talk of the Treasure Coast, and you're on SunPalm Financial Program with Mr. David Cummings. Good morning, sir.
Hey, good morning, and welcome to everyone who's joining us today. It is definitely a beautiful day here in South Florida, and while we're chiming in, lots of interesting things happen in the financial world, lots of interesting things happening around the world. Today's topic, though, is going to be on advanced investing principles. Now, this is a part two. Last week, we talked about basic investment principles. We posed the question, if you had $1 million, what would you do with it, right? We had some great answers coming into Facebook. We're live today again. Just to see what you would do if you had $1 million. Last week, the gentleman reached out to us and he said he would buy a house and he would buy a Ferrari or a Lamborghini or one of these expensive cars. And we kind of coached him on how you can have your cake and eat it too.
I would buy a yacht.
You'd buy a yacht. Would you travel the world?
Oh, I'd love to.
Where would you go first?
I don't know. Probably head south.
Caribbean, Mediterranean?
Yeah, Caribbean, I would think. The islands down there, yeah.
Okay, how about it heading up to the coast through the Strait of Hormuz up there where the Houthi rebels are right now?
That would be more exciting.
You definitely get an exciting trip through that part of the world.
Not exactly a tourist spot.
This is for sure. Well, I've actually heard that now, we had seen the Somali pirates were kind of at bay for a while now, but now that the U.S. Navy has been rerouted up there, now they're kind of getting active again. So hot spots everywhere. So I don't know if it would be a good plan to buy your yacht just yet. So save and invest a little bit more. Before we get started, I like to always advise that we sometimes make financial decisions and suggestions in the broadcast. So I like to put out a quick disclaimer. The information and opinions obtained in this broadcast have been obtained from sources believed to be reliable, and they are given for informational purposes only. The information is not intended to be used as the sole basis for financial decisions or as a solicitation to sell. All right, so last week what we kind of hit on was, some of the concerns that are going on when it comes to educational system, that money's not taught in schools. And so, even as kids are kind of getting into college, focusing even on a business degree, they're still missing huge components of how money works, how it operates, how to invest for the future, the short term, long term, what type of investment vehicles are out there, and these kinds of things. So if you haven't caught that one yet, you can go to WPSL TV, SunPalm Financial, and that will be getting posted sooner than later, hopefully. So we were talking about in our basic investment principles, that, and it sounds common sense, you want to buy low and sell high. We talked about how typically people are like, oh, wow, that stock is really performing, let me buy it. And of course, you're buying high, and then when it takes a dip, then you're losing money. So we want to try to train ourselves to kind of be looking at things in a different direction, kind of in reverse because of that. Now, today's, some of the subject matter that we're going to be talking about, I have to give credit to Ben Taylor from Investopedia. He did a great research on some of these topics, so I'm going to be quoting some of his work today. But while we're getting into the advanced investment strategies and principles, there's a couple things that, they may sound advanced, and I'm going to try and break them down to the lowest common denominator so everyone can understand it. So when we're talking about investment strategies, there's three main principles, right? So the first thing we want to do, we want to commit to a timeline, okay? So if we don't give our money time to grow, compound the interest, well, then we're not really doing much. And I say that because there are a lot of people, what they'll do is they'll buy this stock, it's not doing really great. They'll move it, buy this one over here, it's not doing really well. Time is your best friend if you're in the right place. The other thing you want to do is be able to determine your risk tolerance, right? And then you want to pick the type of investments that will match that. We talked last week, and I can't stress it enough, invest in what you understand. A lot of people jump into these crazy exotic type of things and they just don't really understand what they're investing in, and it's no secret they lose their money. So there's also some other factors that we want to talk about when we're looking at investing. So the first thing is asset allocation is really everything. So you don't want to just put all your eggs in one basket, right? So asset allocation, what that basically means is you're putting your investment capital into several types of investment, and each represents a percentage of a whole, right? So allocating assets into different classes that are not related, it's a good way of spreading out your risk, all right? So I love the old adage, don't put your eggs in one basket. This is so true. If you have your investments kind of diversified, is what we like to call it, spread out in different directions, what you're doing then is you're spreading out the risk. So let's kind of talk about this. For example, you might put half your money in stocks, you might put the other half in bonds, right? If you want to diversify your portfolio even further, you can throw some into asset classes like real estate, commodities, international stocks, Forex, which is foreign exchange, currency exchange. Annuities would be another great one, and other insurance products. And to know the right allocation strategy, you kind of need to understand your own tolerance for risk. So if temporary losses, for instance, terrify you, obviously you want to concentrate on lower risk options like an annuity or bonds, these kinds of things. And if you can, weather these types of setbacks that can come with some of the stock market type of stuff, then you have to kind of look at long-term investments in your stocks, bonds, mutual funds, these kinds of things, right? So your first plan, if you're investing in stocks, you don't want to put it all into one stock. You never want to do a one-off. Now, I'm going to.
But I was told Enron is really high.
There are exceptions to this rule. If we could all go back 20 years and invest in Amazon or Facebook or whatever. I have a little story on this I like to tell, okay? Now, when you're looking at your risk tolerance, you're looking for that long-term investment, but there are sometimes going to be short-term opportunities where you can make a buck, and quite a bit. I'll give you two of them that I've been a part of. So the first one, this is back, man, it was probably 05, 06. There was this very famous lady named Martha Stewart. Yep. Martha Stewart had been accused of insider trading, and she had a conversation with an investigator, and apparently she didn't tell the truth during that conversation. And actually, it wasn't the insider trading that got her. She was not convicted. I don't even know if she was charged with it in retrospect, but she was charged with not telling the truth, and she went to prison.
You don't lie to the FBI.
Yeah, and so everyone said, oh, well, there goes Martha Stewart. She's done. Well, I said, I don't know. I think I would invest a bunch of money, when her stocks just plummeted, whatever. And she had what was the name of her show? But she had a TV show and a production company. And she also had I think it was a clothing line and some other thing. So her little company, the stocks just plummeted because they thought she's done. So back then I had conversations with some folks and I said, I would jump on that. And they said, really? I said, yeah. They said, well, how come? I said, well, in 6 months when this lady gets out, she's going to be a superstar. She's going to be a rock star. And they're like,
she's a martyr.
yeah. They're like, no, she's done. I'm like, no, she's not done. I said, this is America. And in America, the crazier situation you find yourself, when you come out on the other side, people are rooting for you. America loves the underdog. And so, man, just as predicted, she got out of prison and her TV show just took off. She, as I recall, her performance after the fact was better than it had ever been up to that point. And so this growth happened so fast. A lot of people made some money there. Short-term investment made a bunch of money. I'll give you another one. This is a recent one. As you recall, during COVID, the movie theaters were closed.
Oh, yeah. Yeah.
They were empty. And so AMC was essentially going out of business. This is the movie houses, right? And some very smart investors saw what I saw and they jumped on it and they invested in AMC. They kept them from going under. They bought equity into the company and whatnot, kept them from going under because they believed that once this whole COVID thing was finally over, if they could just keep them alive for a period of time until things turned around, people would be so happy to just go on a date to the movies that their company would just have a huge rebound. And guess what? That's exactly what happened. So these guys, these folks, and jumped in there. They invested in AMC. They saved the company. And then Mr. Tom Cruise himself, with his movie Maverick, literally saved Hollywood. He saved the entertainment movie house industry 100%. And so huge explosion of income for whoever jumped into that one. So there are these one-off situations, but it could also be a gamble, you know, and some of this is where we talk about risk tolerance, right? So would you have put all your eggs in that basket? Never, ever. But you definitely could have maybe gotten a good little piece of action in there. So one of the things at SunPalm Financial we talk about, and I'm going to go into it in more detail, we call it the trifecta. So this is a threefold way of investing: stocks, bonds, mutual funds for growth, investment products and insurance like annuities for security, regular returns that you can count on, something like a MYGA annuity. And then the third would be something hard assets, real estate, gold, those kinds of things. So this trifecta, what you're doing is you've got stability here in the annuities. You've got stability on the real estate and a hedge, really, with the gold, hard assets, something that you can physically touch and see. And then over here, your stocks, bonds, mutual funds, that's for growth. This trifecta has worked for as long as I can remember. My first financial advisor that I ever spoke to, he and I sat down and he had this similar strategy, and I have used it ever since. And I'm now what, 51? So this would have been 30 years ago. It has worked over and over and over, and we've now weathered major, financial economic crisis. So
There have been?
oh yes, and they come about. That's the other thing. These things come about every 7, 8 years.
Yeah.
They cycle
If
through.
you look at it, yeah.
So let's talk about it. 2008 was the start of the MBS, mortgage-backed securities crash. That lasted for a good 3 to 4 years. And then after,
Which in a way was artificial.
in many ways. And then later on here, then we have COVID, right? Not even 10 years later, more or less, coming down the road. So after 3 or 4 years for the other, and after we're kind of coming out at the tail end of that, and then this occurs and so on. So the trick is to catch your investments on the upswing, which is essentially what I did with real estate. When it was at the bottom, we had the real estate at the bottom, we had the rates at the bottom. I just took that, I pretty much did go all in. It was huge risk to do that, but I just saw there's no other place for it to go but up, and it was true. So, but this trifecta, this is kind of the approach. And then the secondary part of this is when you're talking about your income, if you can manage it, and what you should be striving for is to have income coming also from 3 different places. So if you've got your job and you buy, let's say, a rental property and you're getting money from rent, and then the money that you're getting from the rent, you take some of that and you invest it in maybe a mutual fund or an annuity. And then after a bit of time, those 3 things are playing out simultaneously. So you're getting rental income, you're getting income from your job, and you're getting income from your investments. And so if you lose your job, guess what? You're not out of luck. You've got income coming from 2 different places.
2 out of 3, so you're good.
Exactly. If the rental market is just, terrible and costs of running a house is expensive like now, it's okay. You got a job over here and you've got passive income from your investments, right? So if you understand this philosophy, this is what you should be working towards. This is something we'll do for you at SunPalm Financial. We'll look at your current portfolio, we'll make sure that it's allocated properly, and we'll start to set you up in the trifecta. Okay, so let's continue. So we talked about this part of things, which is diversification. So by having this diversity spread out, you're limiting your risks. And when the storms come, because they will come, you're protected in many ways. We're going to go to a break. When we come back, I'm going to talk about precious metals, gold specifically, as a hedge, and we're going to talk about how that looks in real life. Be back in a minute.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at SunPalm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, call right now to schedule your free consultation so that you can join the old club. SunPalm Financial. Invest, grow, protect. SunPalmFinancial.com.
Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to SunPalm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. SunPalm Financial. Invest, grow, protect. SunPalmFinancial.com. All right, welcome back to the SunPalm Financial Broadcast. I'm your host, D. Thomas Cummings, and we're talking about some sort of advanced level investment stuff. Now, the stuff isn't really advanced, but there are some phrases we'll be using that are a little bit above people's heads. They may never have heard them before, so we're going to break them down to the lowest common denominator. But one of the things that we were talking about just now is what we call at SunPalm Financial, we've coined this phrase or this investment strategy called the trifecta. So we're talking about investments in stocks, bonds, mutual funds, some growth stuff over here, some insurance products like annuities over here for stability and income, and then hard assets, real estate, precious metals over here. So I do have, and we also talked about making sure that your income, you want to build income to come from 3 different sources and preferably be able to live off of one. Now, That way, when the trouble times come, you lose your job, you've got these income sources. If these income sources aren't playing out, you've got your job, etc. Now, one of the things we were hitting on was hard assets. Now, I have a gold story for you. Precious metals, by the way, just hit over $2,300 per ounce spot price. Now, 10 years ago, gold was at $1,300, roughly. So $1,300, and here it is now, $2,000, almost $400 in 10 years. That's tremendous, right? So people say, what's prompting this? Well, we're going to talk about that towards the end of the show. Why do people invest in gold? I've heard people say, oh, that's the dumbest thing ever. Now, they may invest in a gold stock or something like that. I'm not a big fan of that. I want the physical, tangible asset in my hands. You better have a good safe, and you better keep it on the down low because you don't want people to steal it. But here's an interesting thing. Of course, gold has been around for thousands of years. It's had value as a currency. It's had value for multiple, all around the world for thousands of years, right? It is also used in electronic devices, which are now everywhere, from your hand to what's on your head to the computer in front of you. The radio station here, I'll bet you there's several pounds of gold in all the little components here. So there's an actual use for it in that regard.
I'll just trash the equipment and then
It's probably
melt down
worth
the gold.
Yeah, it's probably worth more like that. Also, gold as a jewelry type of thing. The ladies and the guys love the gold. So there's a value there. So definitely it is something that is an asset. But when it comes to investing, it's often referred to as a hedge. In other words, if the economy crashes or things go south or whatever, you have something of value that will actually go up. If the dollar were to crash, gold would go up. If your currency in your country where you're listening, because we're on Google and Alexa, we can be heard worldwide right now. Gold in your country, if your currency crashed, gold is going to be there, and it's actually going to probably go up. So here's a real life gold story. There's a gentleman, Ukrainian gentleman, when Russia invaded that part of the world, this guy had a good little stash that he had accumulated over his lifetime. I think that from what I understand, his father had started investing in gold after World War II. And as you recall, in World War II, after the Great Depression, it was outlawed to possess gold in the United States. Do you remember this? So some people kept it under the mattress, right? So after World War II, the grandfather or his father started investing in gold, had some that he passed on to him, then he started doing the same thing. What am I talking about? When Russia invaded, this guy took his family in a suitcase full of gold, physical gold bars, and he leaves the country. Do you know he was able to literally transport his entire wealth to a new country like it never happened? Now, he lost his asset, his home, back in his home country, but this guy, he came into the country, he declared it, which you have to, or they could seize it. He declares how much he has, and he literally sets up shop, contacts, whoever the gold bureaus are, Kitco or whoever, and he sells it back to them, or a portion of it, and he cashes in and starts his new life. That's a true story. So that's the real value of gold if you think about it. You have someone that can literally take their wealth and just transport it across the world.
That's a great story.
It's a true one. So, and this is not a first time that this has happened. This has happened in many conflicts over time when people had their money in the bank or in whatever currency. Now, let's do the math. If this guy had his money sitting in the Bank of Ukraine, what happened to the value of their money? After the invasion, what happened? It went to nothing.
Oh, I was going to say.
Just crashed, right? But his gold didn't. In fact, his gold is now more valuable than, you could shake a stick at, bottom line. So gold is definitely something to think about. Not just when they say a hedge, that's not just, hey, I'm hedging, I'm protecting a certain amount of my wealth. It's a smart strategy because the world is an unstable place. As we're sitting here right now, we have wars in the Middle East getting worse and worse, more out of control. We have wars in Europe out of control. We have threats of wars in the South China Seas with Taiwan. We have instability and literally gangs taking over states or trying to in South America. I believe they've achieved that. We have a fallen state in Haiti. And South America, we have countries, the presidents have literally had to turn their entire military against some of these forces, the narco states in some of these situations. Man, it's good to have your wealth that you can just pack up and go wherever you need to, right? And I'm sure on his way out of the country, somebody might have stopped him and said, hey, all men of military age or older must go, back into the country to the front line. Throw them a couple gold coins, you're out. Yeah. Right. In fact,
never saw that guard.
Yeah, never saw him. Why is that younger, older man getting on that train and leaving? Aren't they supposed? Oh no, he's handicapped and he's gone. Yeah, whatever.
Why did we get off the gold standard for our money?
Great question. First of all, there's not enough gold in the world, right? I think the numbers I've heard is all the gold in the world put together probably would fill up 4 Olympic swimming pools, right? Yeah. So that's another very good question that you ask, because if something has a tremendous value and it's a limited resource, it'll even get more valuable as time goes by because there's just not enough of it to go around. Now, we got off the gold standard because they kept bankrupt in the country, really. They kept really messing things up. And so they wanted to create a fiat currency to try to create another way for us to transact business and goods and services. Great book on that one, The Creature from Jekyll Island. Take a look at that. It talks about the people who established the federal banks and whatnot. And that's a whole story in and of itself. But anyway, there's also other precious metals, silver, doing really well, platinum, uranium, different types of minerals that are out there, rare earth minerals that are used in batteries, which now with the cars and whatever. So definitely some opportunities out there. If you haven't had your catalytic converter sawed off of your car in the middle of the night, then you're pretty fortunate. That's because the precious metals that made up the catalytic converters went really high for a period of time there. And so we had some black market criminal activity. People were, melting that stuff down, cutting them off, melting them down and cashing in. So, but it underscores a very important truth, which is that you do need a hedge for your worst case scenario. It's not conspiracy minded to do so. You should have that, right? So the Ukrainian gentleman's home was probably bombed. That's an asset, physical asset, gone. Whatever money he had in the bank, gone. There's that, right? So ultimately, stability in a country is a very powerful and important aspect of a financial plan. If you're going to relocate to some country, it better be stable, right? Its banking systems better be stable. So that's something. There's your yacht up there. I was just looking. You missed it. Up on the TV, I was looking at this beautiful, beautiful yacht. And you know what? Hey, if all Hades breaks loose, you take your gold and you hop on your yacht and you go anywhere, right? All right, back to diversification. So when we're talking about diversification, like we said, we want to spread it out during, to different asset classes. But a part of that should be something that is for growth. We talked about stocks, bonds, mutual funds. We talked about time. So magic of compounding. If you're investing your money and it's gaining interest and you don't touch it, we now have the snowball effect. Your money is gaining interest, and if you don't touch it, that growth happens, and then the interest that continues will be not only on your original money, but also on what it's gained in interest.
Makes sense.
And this is what's called compounding interest. And it grows, grows, grows. Last week we had a great example. Harry Markowitz wrote a book called The Only Free Lunch in Finance. And he talked about how if someone put $100 in the S&P 500 in 1970, it would have grown to $7,771 by 2013. So now it's 2024, it'd be even more. So just sitting there, it didn't do a thing. It just put it $100, sat in there. And we ran the numbers on some of these other things. If you had put a certain amount in, didn't touch it, whatever. So the magic of compounding interest is real. It's no joke. So as we're looking at investing, we don't want to just put it under the mattress, because we also talked about last week, if you were to take your money and just stick it under the mattress with the inflation, it's going to be disappeared, all but disappeared by the same amount of time if you had invested it, right? So we talked a little bit also about traditional and alternative assets. So what's a traditional asset? Of course, stocks, bonds, mutual funds. By the way, mutual funds are when you invest in multiple stocks in one group, right? Typically 99 makes up a mutual fund, but there are other variants to it. Also, getting something here on the, we asked what would you do with $1 million? This person said, invest in gold.
Yeah. There you go.
Well, think about it. If you had $1 million, you invested it in gold in 2015, which was at 1,300 an ounce. And
Wow.
now it's at 23, almost 2,400 an ounce. It's grown $1,000. Do the math. Million times 1,000 for, right? Am I doing this right? Because the number is coming back kind of crazy. So yeah, absolutely. Good answer. By the way, if you want to chime in, what would you do with $1 million? You can go to us Facebook Live, or you can call us at 772-340-1590. All right. So traditional, by the way, 772-340-1590. I like to repeat it twice so you can get it if you want to call in. Traditional assets, stocks, bonds, mutual funds, cash. What is cash? Cash is money in the bank, like savings accounts, certificate of deposit. Alternative assets, there's some value in some of these. So commodities, real estate, we talked about, foreign currency, art collectibles, those kinds of things. What's this show? Antique Roadshow? Ever watch this?
Oh, yeah.
Guy goes into his dad's closet after he passes away, and he's got his grandpa's old first Rolex, and it's worth $100,000 or something.
And a
crazy.
Mona Lisa.
And a Mona Lisa
yeah.
gets found in a thrift shop somewhere, for sure. There's also derivatives, some venture capital stuff, special insurance products, private equity. So these are some traditional and alternative asset classes.
But your risk tolerance has got to be pretty high.
That's exactly
for
where
that.
I'm going. Yeah. So again, some of these things are very specialized. Don't invest in something you don't understand, right? I'll give a good little, for instance. We had a neighbor, he's passed away now, and I'll tell you this story. So this guy invested in China, not the country, but the plates, the dishes, the cups. He had this thing for it, and he had his entire garage full of it. And my other neighbor referred to him as the Chinaman. And I asked him why, and he told me that's what he does. So one day, curiosity killed the cat. I go down to his house, look in the garage. This guy has like sets of china that are just beautiful. And he used to make a lot of money selling them. And anyway, he passed away. God rest his soul. He was a great neighbor. And his children inherited this. We're talking tons of money, hundreds of thousands of dollars. Yeah.
In his garage.
Yeah. So basically they just they linked up with an estate sale person, high-end estate sale, and started auctioning this stuff off, brought in a couple $100,000 just in this stuff. So this guy knew what he was doing. He knew what he was buying, and so on. So, all right, so let's move on, talk about some other things. When you're picking stocks, you're looking for stocks that offer a higher long-term appreciation than bonds, of course. You're looking at factors like P/E ratio, dividends. Let me describe these. This is where we get a little technical stuff. I'm going to define it for you. Dividends is the distribution of corporate earnings to eligible shareholders. If you buy shares in a company, company does well, the profits get shared to the shareholders, which would be you. So you not only get the value of the stock, you also get extra money called a dividend for the profits that were made. So let's just do some numbers here. They're a pretty serious driver of wealth. Going back to 1960, 82% of the total return from the S&P 500 index can be attributed to the reinvestment of dividends and the power of compounding interest, which we talked about. And this is according to the Hartford Fund's white paper. In addition, dividend payments are a sign of a healthy company. They let you know that you're invested in a good company. So P/E ratio. What is P/E ratio? And this is something you need to know as an investor. P/E ratio is price earnings ratio. So what is it? It's the company's current share price compared to its earnings per share. So for instance, P/E ratio of 15, for example, that tells us the investors are willing to pay $15 for every $1 of earnings the business earns over that 1 year. So that's your P/E ratio. Now, it's kind of the most commonly used measurement for stocks' relative value, right? So for instance, a high P/E ratio indicates that investors have a greater expectancy for the company to do well. And that could be unrealistic too, but this is just how it's measured, right? Low P/E ratio would be company is undervalued or that investors expect the company to face more difficult times ahead. So for instance, when you look at, we talked about AMC. AMC was always a decent, steady company performing well. People love to go to the movies on a Friday night. And after COVID, it went down. That had a low P/E ratio because people didn't think that it was valued well enough, right? That they knew tough times were ahead. But the smart people looked way ahead and said, no, when this COVID thing's over with, people are going to just be desperate to get out of their house and they're going to go to the movies and then the value will shoot back up.
I got a question on, some friends of ours bought, and this is 30 years ago,
Yeah.
AT&T.
Yeah.
Now, the current AT&T is not that AT&T.
Right.
It's really Southwestern Bell.
Correct.
So now,
So the
how does
question
that
is,
work?
right. So when a company purchases another company, they purchase the company's value, its shares, everything. Now, it also depends on how it's negotiated in the sale, but absolutely. So for instance, I own company A, it does a certain performance, and then a bigger company comes in to swallow up more of its market share in its industry, and it buys that company. Well, now the shares and value in that company can be transferred into the new one, and that's another great point. There are a lot of people in Wall Street who have made a ton of money just in the purchases of companies, right? So they see a smaller company, they see the value in it, it's got a certain value, they invest in it while it's low, initiate the purchase, and now the umbrella of this larger, more successful company, the values shoot up and they make a bunch of money. And then there's some people who will then immediately dump it, right? So they purchase it, drive it up. There are also other people, it's the other end of the spectrum. They look at a company that's struggling and it has a certain value, and they'll buy the company just to break it up and sell off its different parts. Kind of like this. I buy a car for $10,000, right? If I were to take that car and take all the parts off of it and sell them, to junkyards or whatever, that car's value is now $20,000, right? because broken apart, the parts, the value of those parts has a higher value than it did as an operating vehicle. So that's another aspect of it. So P&E ratio helps to tell us a lot about that. Another variable is called beta. What is beta? So this number indicates the volatility of a stock in comparison to the market as a whole. So a security with a beta of 1, for instance, will exhibit volatility that's identical to the market. So when you see the number 1, it's moving with the market, right? Any stocks with a beta lower than 1 is theoretically less volatile than the market. Stock with a beta above 1 is theoretically more volatile than the market. So for instance, let's say you have a security with a beta of, 1.3. So it's 30% more volatile than the market. If the S&P rises 500, S&P 500 rises 5%, a stock with a beta of 1.3 can expect it to rise by 8%. That's how you run the numbers, right? So again, some of this stuff might be a little bit over people's heads. I really encourage you, talk to a professional when you're looking at investing in the stock market for some of these reasons. Now, EPS, earnings per share, that's a dollar figure representing the portion of the company's earnings after taxes and preferred stock dividends are paid out that's allocated to each share of the common stock. So investors will use this number to kind of gauge how well a company can deliver value to its shareholders. Higher EPS means higher share prices. Number is particularly useful in comparison to companies' earnings estimates. And if a company regularly fails to deliver on their earnings forecasts, an investor might want to reconsider that purchase, right? We're going to go to a break. When we come back, we'll have about 10 minutes more to kind of talk about some other strategies, and we'll pick it up from there. Dreams. What do your dreams look like? And how far are you willing to chase them before giving up? Or are you willing to stay the course to achieve them? Do you dare believe? Are you willing to work for them, strive hard, to never give up until they are realized? Are your dreams worth chasing? Well, if they are, welcome to SunPalm Financial, a place where dreams become a reality. Whether your dream is to grow and to thrive towards the good life, or to simply experience freedom through financial security, come share your dreams with us. SunPalm Financial. Invest, grow, protect. SunPalmFinancial.com.
Old money. Why is old money respected more than new? It's not because new money spends their fortunes outrageously and the old money gets jealous. Old money is respected because it has grown over time and is maintained over many, many generations. You see, most new money will be blown eventually or wasted by the second generation. And the descendants of new money just get poorer and poorer after that. But at SunPalm Financial, we'll help you to create generational wealth that will grow with each new chapter. So if you've been fortunate enough to come into some new money, call right now to schedule your free consultation so that you can join the old club. SunPalm Financial. Invest, grow, protect. SunPalmFinancial.com.
All right, welcome back to the SunPalm Financial broadcast, where we talk all things money. And today we're talking about some more advanced level investment techniques. And we've been talking about some stuff, mainly right now focused on stocks and things like this, beta, EPS. And now we're kind of moving on to the last part here, historical returns. So when we're how do you value these companies, right, to invest in? So I did my executive education through the Harvard Business School in financial accounting, and one of the things that we focused heavily on was how do you look at a company and tell whether it's coming up or going down, or whether it's just stagnant, right? There have been a lot of people who have bought companies and lost their shirt because they couldn't read the numbers well. So understanding these things is the difference between good gains, bad gains, or literally losing it all if you go all in. But we've already talked about the trifecta technique with SunPalmFinancial.com, and we talked about how you diversify, spread out your assets. So this last part, we're focusing on the growth component of stocks. And the last part of this thing is historical returns. What is the best way to kind of predict what a company's going to do? Historical returns. So, for instance, past performance is not necessarily a predicator of future returns, obviously. We've heard of this. But if I have a track record and can look at something's performance over time, I'm going to be able to see what it's doing and how it responds to different situations, market shifts, these kinds of things. Like, I'll give you, for instance, and this is kind of an interesting one. We were talking about different investments earlier. So let's look over the past 10 years. I ran some numbers. Over the past 10 years, stocks have averaged around 12.75%. Yep. Now,
Average?
10 years, yeah.
Wow.
Yeah. And now this is the higher end stuff, S&P 500. By the
Yeah.
way, S&P 500, for those of you who don't know, that's the Standard & Poor's 500. That is, Standard & Poor's is a rating agency that basically looks at companies and rates them. So the S&P 500 is the top 500 companies and how they're performing. So this is one of the gauges that the stock market uses, right, to look at performance. So 12.75%. Now, that sounds great. You throw in dividends coming up to around 14%. But here's the problem. Here's the problem. That trend was going up, and then it takes a shift and it's starting to head in a... So do you want to jump in now, or do you want to wait till it gets to the bottom and then buy low, sell high, right? So that's something to think about. U.S. real estate, and by the way, stocks, you know, some can have, these are averages, so it's not specific to one thing. U.S. real estate in the United States, 8.6% has been the rate of return over the past 10 years. So throughout the country, real estate's done about 8.6%. The reason why I highlighted specific stocks may do better, much better, or much worse, Florida was 191.9. A house back 10 years ago was about 100 and average price about 150. Now we're talking 450. Okay? 191.9% in value right there. Stability, lack of volatility. You want that thing that you can count on as you get older that's going to be there for you. Annuities, people. A fixed annuity or a one with a lifetime income rider put in there. Now's the time to jump on that. We're doing a lot of them.
That's what I want to get for Carol.
Yeah, we're doing a bunch of them. Give us a call at SunPalm Financial if you want to talk about that. It's definitely something you should jump on. SunPalmFinancial.com. You can also call us 561-783-3334. It should already be part of your portfolio. If it's not, jump on it. If you get to retirement and you have to kind of put it all in, most of it in one different direction, that's definitely the place where you should look. So annuities, similar to the stock market. If you're looking at indexed annuities, which are tied, to the performance. So think about it. Stocks are at 12.75%. Dividends give it about 14. Indexed annuities that are tied to the S&P 500 are doing this very similar performance, but there's no downside risk. When the stock market crashes, you lose your money. Annuities crash, you don't lose your gains. So definitely something to think about and jump on. So historical returns will show you a lot about what your performance has done through time. The longer time you have, the more of a picture you get. And some things to consider as, things are moving ahead here. Some dangers we're seeing. We have a national debt that's extremely high. It's out of control. And we have a low GDP, which is not matching the debt. It's not keeping up, much less surpassing it. We used to be exporting a bunch of gasoline, natural gas, oil. We had, under the last president, that we were exporting, I believe, more than we were importing. And we were starting to see the GDP drive up into the 4% range and was actually on track to be much better. And then America made another selection, and I think a lot of people, taking politics, parties out of this, I think a lot of people are tired of the current situation. We had record inflation at some point, over 9%. It's insane. So think about that as we're moving forward. Inflation, we talked about, it still hasn't gone down. The interest rates of houses, residences, they're not going down anytime soon, according to the Fed. And now we're looking at mass unemployment to compensate. Companies are laying off people like crazy to compensate for these changes.
Robots.
Yeah, robots, AI, replacing a lot of jobs. And, these are some real things to think about. So a lot of challenges now. If you'd like to talk to us at SunPalm Financial, we're professionals. This is what we do. 561-783-3334. And you can find us at sunpalmfinancial.com. We can look at your specific situation. And if you have no money, none at all, we can get you set up on a life insurance policy to where down the road, when your date with death comes, you've left your family in a good spot. sunpalmfinancial.com. Thank you again for tuning in to the SunPalm Financial broadcast. We'll be back with you next week.
All right. And David, again, how do we find you on the web?
www.sunpalmfinancial.com, 561-783-3334.
All right. You have a great week, sir.
Same to you.